What if I told you that the entire financial industry is being quietly revolutionized by algorithms, and most people have no idea it's happening? Today we're diving deep into how artificial intelligence is completely transforming the way money gets managed and why this might be the biggest shift in finance since the invention of the stock market itself. Picture Wall Street in its heyday: sharp suits, expensive watches, and traders with egos that could fill Madison Square Garden. These were the Gordon Gekko types who ruled the financial world for decades. Back then, investing was simple in concept but messy in execution. You found a money manager, handed over your cash, and hoped they had some magical ability to pick winning stocks. Sometimes they did well, often they didn't, but at least there was a human story behind every decision. These traditional managers would spend hours analyzing company reports, listening to boring earnings calls, and crunching numbers on spreadsheets. Then, more often than not, they'd ignore all that research and make decisions based on gut feelings or hunches about the next big thing. It was like sophisticated astrology for people who wore expensive cufflinks. For the longest time, this system actually made some sense. Markets moved slowly, information was hard to get, and having a professional guide felt necessary. Data was expensive, research was limited, and trying to invest on your own was like attempting to navigate without a map. Financial advisors weren't just money managers, they were gatekeepers to an exclusive club that regular people couldn't access. But then something fascinating happened that changed everything forever. The math nerds arrived. In the late 1980s, a new breed of investors emerged. These weren't your typical Wall Street characters. They were PhD mathematicians, statistics professors, and computer science wizards who looked at markets completely differently. Instead of asking whether a company was good or bad, they started asking a much more precise question. Given these specific variables, what's the mathematical probability of this outcome? This was the birth of quantitative investing, and it was revolutionary. These quants discovered something that traditional investors had missed for decades. Markets weren't completely random like everyone thought. They were statistical. Human behavior follows patterns, and those patterns create opportunities for those smart enough to spot them. The most legendary example of this approach was Renaissance Technologies and their flagship Medallion Fund, run by mathematician Jim Simons. This fund became the most successful investment vehicle in human history, yet most people have never even heard of it. Using purely mathematical models and machine learning algorithms, the Medallion Fund generated returns that seemed almost impossible. Here's how incredible their performance was. For over 20 years, they averaged 60% annual returns before fees, and 39% after fees. To put that in perspective, Warren Buffett, widely considered the greatest investor of all time, averaged about 19% annually throughout his career. If you invested $10,000 with Buffett's track record over 20 years, you'd end up with around $324,000. That same $10,000 invested with the Medallion Fund would have grown to over $7 million. This wasn't luck or market timing. This was pure mathematical precision applied to financial markets, and it worked so well that it completely transformed how institutional money gets managed. These algorithms could process vast amounts of data, identify patterns, and execute trades at speeds no human could ever match. While quantitative funds were quietly dominating institutional investing, something else was happening with regular everyday investors. Mountains of research started proving what many suspected but few wanted to admit. Most professional money managers were actually terrible at their jobs. Study after study revealed that roughly 90% of active fund managers consistently underperformed simple market benchmarks over long periods. When you factored in the fees they charged for this underperformance, the results were even worse. Investors started asking the obvious question: why am I paying extra money to get worse results? This led to the rise of index investing, a completely different philosophy. Instead of trying to find the needle in the haystack, investors began buying the entire haystack. Index funds offered something revolutionary: market returns at rock-bottom costs with zero human drama or ego involved. As retail investors flocked to index funds, institutions started moving their money away from traditional active managers toward alternatives like quantitative firms, private markets, and in-house investment teams. The traditional stock-picking money manager was slowly becoming extinct, fees compressed, careers evaporated, and capital fled the industry. But here's where things get interesting. Even though active stock picking was dying, there was still genuine demand for the boring but essential parts of portfolio management. Things like rebalancing, asset allocation, tax optimization, and general account maintenance. All the tedious busywork that financial advisors use to charge hefty fees to handle. This created the perfect opportunity for robo-advisors to emerge and fill that gap. Now, before we go further, let's clear up a massive misconception. When people hear that robo-advisors use algorithms, they often assume this means they're doing the same thing as those sophisticated quantitative hedge funds. This couldn't be further from the truth. Quantitative firms like Renaissance Technologies use algorithms to exploit microsecond market inefficiencies, execute complex arbitrage strategies, and generate alpha through advanced mathematical models. Robo-advisors, on the other hand, are basically automated investment platforms designed to deliver low-cost market returns with minimal human involvement. Comparing how these two use algorithms is like comparing a Michelin star chef to someone heating up a frozen dinner. Robo-advisors aren't trying to beat the market. They're trying to replace all the administrative benefits of having a financial advisor without paying the typical 1% annual fee. They handle asset allocation, rebalancing, tax loss harvesting, and all the other portfolio maintenance tasks that used to require expensive human expertise. The value proposition was immediately appealing to investors. Platforms like Wealthfront and Betterment exploded in popularity. 10 years ago, Wealthfront managed just $2 billion in client assets. Today, that number has grown 40-fold to $80 billion. This isn't just one company's success story. Globally, robo-advisors managed around $187 billion in 2017. By 2023, that figure had jumped to nearly $2.8 trillion. Industry projections suggest this could reach $4.7 trillion by 2027. This represents a fundamental structural shift in how investment management works, not just a temporary trend. But robo-advisors aren't perfect, and there are some significant issues that don't get discussed enough. The biggest misconception is around personalization. Robo-advisors market themselves as providing personalized investment solutions tailored specifically to your unique situation. The reality is much more mundane. When you sign up, you complete a questionnaire covering your age, income, time horizon, goals, and risk tolerance. This process feels thoughtful and customized, but what actually happens next is quite different. Instead of creating a unique portfolio just for you, the algorithm categorizes you into a bucket and slots you into a model portfolio shared by thousands of other people who gave similar answers. You're not getting some hyper-intelligent AI crafting a bespoke investment strategy. You're getting sorted into one of maybe a dozen pre-built portfolio templates. This isn't necessarily bad, but it's important to understand what you're actually getting. Robo-advisors were designed to replace the operational role of traditional financial advisors, not to provide sophisticated investment management. For decades, financial advisors weren't really paid for generating superior investment returns or beating the market. They were paid for access. Access to markets, access to investment products, and access to information that regular investors couldn't easily obtain. This made perfect sense when markets were opaque, data was expensive, and research tools were only available to professionals. But then the internet changed everything. Information asymmetry disappeared almost overnight. Market data became free. Research tools went mainstream. Suddenly, financial advisors weren't guarding exclusive gates anymore, and paying someone 1% annually started feeling questionable. This is the real story behind robo-advisors' success. They're following the same playbook that disrupted other industries. Travel agents didn't disappear because people stopped traveling. They disappeared because booking flights online became easier than making phone calls. Stockbrokers didn't vanish because people stopped trading. They became unnecessary when clicking buy and sell buttons online became faster than calling someone on a trading floor. Whenever access in an industry becomes commoditized, technology tends to replace the middleman layer. That's exactly what's happening with robo-advisors in investment management. The pattern is clear and consistent across industries. When technology finally reaches a stagnant sector, it doesn't make small incremental improvements. It forces fundamental changes that reshape how the entire industry operates. Whether we're talking about quantitative firms replacing discretionary stock pickers or robo-advisors replacing traditional financial advisors, the direction is unmistakable. Artificial intelligence and algorithmic automation are systematically removing human intermediaries from financial services. This transformation raises fascinating questions about the future of money management. What happens when algorithms become so sophisticated that they can handle not just the basic portfolio maintenance tasks, but also the complex strategic decisions that currently require human expertise? How will this change the relationship between investors and their money? The shift we're witnessing isn't just about technology replacing humans for cost efficiency. It's about fundamentally different approaches to understanding and navigating financial markets. Where humans see stories, narratives, and gut feelings, algorithms see patterns, probabilities, and statistical relationships. This doesn't necessarily mean one approach is better than the other, but it does mean the industry is moving toward a future where mathematical precision and automated execution become the dominant paradigm. The Gordon Gekko era of charismatic stock pickers making decisions based on intuition and relationships is giving way to a world where algorithms make most of the important financial decisions. For everyday investors, this creates both opportunities and challenges. On one hand, you can now access sophisticated portfolio management tools at a fraction of what they used to cost. On the other hand, you're placing trust in systems that most people don't fully understand. The key is recognizing what these tools can and cannot do. Robo-advisors excel at handling routine portfolio maintenance efficiently and cost-effectively. They're not going to provide personalized financial planning advice or help you navigate complex life situations that require human judgment. As we look toward the future, the trend seems clear. Technology will continue to automate more aspects of financial services, and the role of human intermediaries will continue to shrink. This isn't necessarily good or bad, it's simply the natural evolution of an industry that remained largely unchanged for decades. So here's my question for you. Have you used a robo-advisor? Would you trust one with your money? Are you comfortable with algorithms making investment decisions on your behalf, or do you prefer having human involvement in your financial life? Drop your thoughts in the comments below. The financial world is changing faster than ever, and understanding these shifts can help you make better decisions about your own money. Whether it's embracing new technology or sticking with traditional approaches, the most important thing is making informed choices that align with your personal situation and comfort level. The age of artificial intelligence in finance has already begun. The question isn't whether this transformation will continue, but how quickly it will accelerate and what new innovations will emerge next. One thing is certain, the intersection of technology and money management will keep producing surprises that reshape how we think about investing, saving, and building wealth in the modern world.